Welcome back to the Wall Street Podcast. Today we're doing a deep dive into some key excerpts from The Economist, the edition from September 20th to 26th, 2025. Our goal here is, well, pretty straightforward. Pull out the critical financial and political threads relevant to markets and institutional reporting right now.
And we've got three main areas to cover from this material. First, U.S. monetary policy and its, let's say, political dimensions. Second, that interesting inversion happening in European equity markets. And third, something pretty important, the accounting practices, specifically around AI at major tech firms.
Okay, let's start with the Fed then. So September 17th, they cut rates. Quarter point.
Yeah, quarter of a percentage point. Brings the benchmark range down to 4 to 4.25%.
And the reason they gave was weak jobs data.
That was the official line, yes. An average of only 27,000 jobs created per month since May. Pretty weak number on the surface.
But is the economic case really there?
Well, that's the fascinating part. It's actually finally balanced. I mean, look at the FOMC vote on guidance for future cuts. It was 10-9, expecting at least 3 cuts this year. That's hardly a strong consensus.
10-9, wow. And this is happening while, financial conditions seem pretty loose already.
Exactly. The stock market's been soaring, and inflation, the Fed's preferred measure anyway, is running at 2.6%, above target.
So barely there consensus for more cuts when markets are hot and inflation's up. Does that immediately make you question the guidance, that political tension?
It certainly complicates things. It signals there might be, shall we say, other factors influencing the decision beyond pure economics. It definitely adds a layer of risk for investors trying to read the Fed's intentions.
Okay, let's pivot to tech. The report talks about hyperscalers' balance sheets. Just to be clear, we mean the huge cloud companies, right? Like Amazon, Microsoft.
Correct. Those are the key players. And the issue is how they're handling depreciation for their AI chips.
What are they doing?
They're lengthening the estimated useful lifespan for these servers, sometimes out to 6 years.
6 years. For AI hardware, that seems optimistic, given how fast that tech evolves.
It does seem optimistic, almost Pollyannish, as the report suggests. If the actual economic lifespan is closer to, say, 3 years.
Which sounds more realistic.
Right. Then analysis by Barclays suggests that the quicker depreciation would actually knock about 5 to 10% off the earnings per share for these big AI players.
So we're not just talking accounting choices. This is significantly boosting reported profits.
Potentially, yes. Across the big 5 AI firms, this accounting method could be inflating their combined annual pre-tax profit by an estimated $26 billion. That's roughly 8% of last year's total for them. Big numbers.
Okay, let's jump across the pond. Europe. There's this market inversion mentioned. What does that tell us about what's going on fiscally?
It's quite a signal. It points towards growing fiscal stress in the core Eurozone countries. Get this. France's 10-year government bond yield, usually seen as pretty safe, is now at 3.5%. That's actually higher than Greece's yield at 3.3%.
France riskier than Greece. That is a reversal.
It is. And at the same time, you've got stock markets in places like Spain and Greece, the former periphery, doing really well, up 32%, 39% respectively. A lot of that driven by banks, actually. So the market seems to be pricing risk differently now, maybe seeing more risk in the core.
And how does politics play into this, specifically in France, with the hard-right national rally? How are businesses reacting?
Well, that ties in, doesn't it? The report notes that the party president, Jordan Bardella, is on what they call an extreme charm offensive. He's actively meeting with the Paris business elite, trying to frame himself as more like Italy's Meloni than perhaps the older image of Le Pen.
So trying to sound pro-business, focusing on innovation, regulation, essentially saying we're not a threat.
Precisely. They're working hard to convince the establishment that they're a manageable political risk. Whether that works remains to be seen, of course.
Let's bring it back to the U.S. jobs number, that 27,000 figure. Is the labor market really falling apart?
It's not quite a collapse, maybe more like a recalibration.
Right.
The unemployment rate itself is still fairly low, 4.3%. But the key context here is migration. Net migration into the U.S. has basically collapsed under the current administration.
Collapsed how much?
Estimates suggest it could even be negative this year, maybe down to minus 500,000, or perhaps up to positive 100,000. It's a huge drop.
So with fewer people coming in, the economy doesn't need to create as many jobs just to keep the employment rate stable.
Exactly. Researchers now figure the break-even rate, the number of jobs needed just to tread water, is probably below 30,000 per month.
Okay. So that 27,000 number, while low historically, might not be signaling disaster in this new context. It almost validates the weak reading.
It changes the whole interpretation, yes. It provides a non-recessionary explanation for those low numbers, which, you could argue, gave the Fed some cover for that rate cut, even with the other pressures we discussed.
So wrapping this up, what's the takeaway for the average person maybe looking at their 401k or just the job market?
It's a bit of a split picture, isn't it? On one hand, their retirement accounts might be doing well, boosted by that market euphoria and maybe some of that generous AI accounting. But on the other hand, they're hearing about stagnant job growth. And the migration collapse kind of validates those low numbers, changing what a healthy economy looks like and potentially affecting job availability perceptions, especially for younger people entering the workforce. I think the biggest risk for you, as an investor or just an observer, is getting caught up in the political noise, whether that's the Fed's internal debates or the charm offenses in Europe, and it's easy to confuse that with the underlying economic fundamentals.
That's a crucial point. Okay, something to really chew on later.
Yeah.
If the Fed's independence looks like it's being chipped away by these very public political pressures like that 10-9 vote, how do you even begin to calculate the real risk premium when the central bank itself starts to look like a political player?